Hello. Well, today we're going to begin with the first of two videos on the topic of dividends. And specifically, we're going to be looking at preferred dividends and how that affects the amount of dividends the preferred holders get and how much common shareholders get under two scenarios. Let's say the scenario of cumulative preferred and non-cumulative preferred. So just to recap though, to make sure everybody remembers this from Introduction to Financial Accounting, when the board of directors of a company declares a dividend, and in this case we're talking about a cash dividend, it becomes a legal liability on that day. Now, if you have preferred shares in your capital structure, then the preferred shareholders have a preference as to dividends, which means they will receive their dividend first. So you absolutely cannot pay a dividend to your common shareholders and skip the dividend to your preferred shareholders. So let's look at a couple of features in this video, and we'll start with this one, non-cumulative. What this means by non-cumulative is that if a company does not pay the required or the specified preferred dividend during the year, then they never have to catch up. They never have to pay it. Now, this doesn't happen very often. A company wants to pay its preferred dividends because if you have preferred shares out there, the only people who bought them are people who want to earn the dividend. That's why they have them, right? So if you just don't pay it, you are in so much trouble. I mean, the market value of your shares is just going to dive. So even though this is a topic in intermediate accounting, we would say it doesn't happen very often. But just the same, you need to know this. So again, non-cumulative means if the dividend is passed, and that's the word they actually use, passed, as in not paid, they never have to pay it again, or they don't have to catch up. Now, the opposite of that is cumulative. And this means if a dividend is passed in 1 year, then the company must make up that money in a future year before any common shareholders can have any dividend at all. So we're going to do an example here, just a short example, and look at a couple or three scenarios of how much preferred shareholders get and how much common shareholders get. So we're going to say that we have 10,000 preferred shares and 100,000 common. Okay, so these are going to be $2 preferred. Now, that's how we're going to write it, but I just want to make sure that you know it doesn't mean that the preferred share costs $2. When you see the dollar sign in front of preferred, it means that the dividend on this share is $2. Okay? And then, of course, common shares do not have a specified dividend. So we just have 10,000 $2 preferred shares, and we have 100,000 common shares. Now we'll do the math. We're going to go 10,000 shares, and we're going to multiply that by $2, and we get $20,000. Okay, so your yearly dividend for your preferred shares is $20,000. And again, there's nothing specified for common. Okay, so let's say that we're just in a standard everyday fiscal year. Everything's up to date, no problems with dividends in the past, and the board of directors declares, let's just say, an $80,000 dividend. So this is the declared dividend. So as soon as this is declared, what it means that whether you have non-cumulative or cumulative preferred shares, you have to pay your preferred shareholders or allocate that money to them first. So here's your preferred dividend. The preferred shareholders in this first example are going to receive their $20,000. And of course, you know, we can do this in our head. We don't need Excel to do this, but we will anyway. The common shareholders are going to get $60,000. So here's preferred, and here's common, and of course it adds up to, these two add up to our 80,000. So that's just a basic starter. Now let's just say instead that it is now year 2, and let's say that we paid no dividends whatsoever in year 1. So I'll just write that down so we don't forget. Year 1, no dividends. No dividends were declared. So we'll keep our $80,000. And so the board has just declared an $80,000 dividend in year 2. No dividends were declared in year 1. So in the first situation, we have non-cumulative preferred shares. What this means is that they have no rights to a year 1 dividend. Okay, so they don't get anything from the dividend that was missed. So no rights to year 1 money at all. So the distribution of the dividend is exactly the same as the first example. They're going to get the $20,000 from the current year, and then the common shareholders will get the remainder. So again, you still have to allocate the preferred shareholders their dividend first, but you have no requirement to pay them in arrears. So now we're going to look at the third scenario. And in this third scenario, we still have no dividends declared in year 1. But what we have instead is we have cumulative preferred shares. So if they are cumulative, then you owe them year 1 dividends before you're allowed to pay any dividends to your common shareholders. So again, let's say that the board declares $80,000 worth of dividends. Okay, so we did that. So here's what we have to do. We're going to take our preferred shareholders and we're going to cover the arrears. And the arrears are year 1 arrears, so $20,000. Then we're still going to take our preferred and we're going to cover the current year. Okay, so the preferred shareholders are going to receive the current year $20,000 as well. So what that means then, of course, is that the preferred shareholders are getting $40,000, 20 from last year, 20 from this year. Now, if we subtract that, again, I know you don't need a calculator to do 80 minus 40, but just the same, we'll just put it on the spreadsheet. And this then is what the common shareholders will receive. Okay, so this is the calculation of dividends. Let's just take a short moment then and look at just the basic year here, and we're going to develop the journal entries for this and just remind you of the journal entries. Okay, so on the date of declaration, a legal liability is formed, and that's why we need to do a journal entry, the date that the board declared the dividend. So, as you can guess, this is called the declaration date. But we need to keep this separate. Now, I'm going to use a dividends account. You may see it simply debited to retained earnings. If you pay quarterly dividends, you might wish to use a dividends account so you don't just kind of mess up or jam up your retained earnings with a lot of journal entries that are unnecessary. So if we use a dividend account, it gets closed to retained earnings at year end. So we're going to do that. We're going to call the first one dividends preferred, and the next one is dividends common. Okay, so we're going to debit that for 20,000 and then that, 60. And then that adds up to our 80,000. Okay, now it's sort of debatable whether you should have a dividends payable preferred and a dividends payable common, so two accounts. But I'm not going to use two accounts because we're going to pay this out at the same time. So I'm just going to credit dividends payable. And of course, dividends payable is now your liability account. It ends with payable. Now, the next date that is important is called the date of record. And there is absolutely no journal entry on the date of record, but as you can imagine, a company can have thousands and thousands of shareholders. So the question is, who do we give the money to? Well, you don't just get to figure that out in the same day you declare your dividends. So what they do is they set a date, and if you own the shares on that date, you get the dividend. And if you don't own the shares on that date, you don't get the dividend, although the dividend will be paid a couple of weeks after this date of record. So this is really about the stock market and who owns the shares on that date of record. So let's say date of record, just for instance, is I don't want that. I want it to look like June 15. Let's say the date of record is June 15. So if you own that share on June 15, you're going to get that dividend when it is paid. So maybe it's going to be paid June 30. But if you sell that share the next day, June 16, well, you still get that dividend, and the new owner who owns it now and bought it June 16 does not get that dividend. So in the market, we say the shares are selling X dividend. So on June 16, someone else buys that share. It is X dividend, in that there's a dividend waiting to be paid, but this guy isn't going to get the money. So now the corporate secretary has an idea of who to give the money to, and then along comes, let's say this was, for example, I didn't put a date here. Let's say this was May 31. Remember, this is not a journal entry here. And then we have the date of payment. So the date of payment we'll just say is June 30, and we simply pay. And when we pay, we're paying off our liability, that is 80,000, and we're paying cash 80,000. So there we have an example of the journal entries that would go with this. Now, if we were doing this other one, we would simply debit dividends preferred for 40,000 and dividends common for 40. That's the only difference that would occur if we had preferred cumulative dividends in arrears.